Well, let's start the financial decision-making part of the course and talk a little bit about how we make decisions in general. And one of the concepts that's going to be key to this particular chapter is what's referred to as the law of one price. So we'll work our way through here, and obviously we need to understand, if you're going to make financial decisions, how do we figure out what value is. And of course we have to be able to identify costs and benefits. We can't do this alone. We need the entire firm. We need the entire corporation, all of its different parts to help us to identify what the actual costs and benefits of purchasing assets might ultimately be. So let's first start talking about what is a competitive market. And a competitive market is one which obviously you can buy and sell assets at the same price. It is an asset. Sometimes we even get a little bit more picky, and we talk about a perfect competitive market where no one person can influence things. We have a variety of issues that kind of sterilize the world and make sure things happen. So what we want to talk about here is obviously the value of an asset comes from the competitive market price. What is the price that's determined in that marketplace? If the values of a benefit exceed the value of the cost of that benefit, then we would be increasing the size of the firm as well as ultimately the market value of the company. This is what's referred to as the valuation hypothesis. As companies build themselves, they ultimately increase the market value of the company themselves. A great example of this is Berkshire Hathaway. Not sure how familiar you are with Berkshire Hathaway, but let's just take a real quick moment here and head out to. I want to head out to Yahoo Finance. Let me put this here so we can see it in the box. We're going to put in Berkshire, B-E-R-K, and I want to do the Berkshire Hathaway. They're a Class A stock, and we want to see what this stock is worth. Berkshire Hathaway is worth $174,907 a share. In fact, at this time, which was 11/19 when I'm recording this, it was up $1,341 a share for the day. Now, again, I don't want to get into all the idea, but Berkshire Hathaway is an example of what happens as companies buy assets that have greater value than what they cost to buy. The one thing that keeps them growing, or at least this particular stock growing, is that Warren Buffett doesn't believe in splitting the stock. They do split the Class B stock, but they've never split the Class A stock. But it is a perfect example of what the valuation hypothesis is all about. We all know what interest rates mean. You know that it's the cost, the price you pay for exchanging money. The risk-free rate is a critical benchmark, if you will, to understand, what rates of return should we ultimately expect when we buy assets. And the risk-free rate gives us a picture of ultimately, I guess, the benchmark, the low end. Anything that you would buy, which would have some forms of risk, should give you a greater return than that risk-free rate. Just as a sidebar, obviously we have to understand about, how do we convert dollars? If you look at how dollars today, how they move back and forward, where we ultimately want to get down here is the dollars in 1 year. How do we move things back and forth? And certainly we can do it looking at commodity prices, or we can do it with exchange rates. But essentially we want to look at the place where we're going here is to talk about what's going to happen sometime in the future. We need to forecast cash flows and bring them back to the present so we can analyze them, so we can understand what their current benefits are. So that present value actually narrows down to one very specific rule. And that specific rule is something called net present value. And the net present value, as you see in our formula here, is the present value of the benefits, which is essentially the value of the asset, minus the present value of its costs, which is its price tag, what the net investment is in the asset. So you can see here if the value, the present value of the benefits, if it's greater than the present value of costs, net present value is a positive number. And of course, we want to increase the value of the firm. Accepting projects that have positive net present value obviously is the equivalent of saying we're going to increase the cash today. We should reject those negative ones because they ultimately are a picture of reducing the wealth of investors. So let's see if we can have a definition. What does net present value actually measure? Net present value measures the change in wealth of the company or of the shareholder. So doing positive net present value projects increases the wealth of the investor. Now this is obviously it's a theory, it's a technique that we can do, that we can calculate this. But of course a lot of things have to be true for this to ultimately come to fruition, if you will. We're going to have to do some forecasting, and all those forecasts have to be correct. We know by definition that there's going to be some error. So net present value is a concept, is an idea that at least measures the change in wealth of the investor. So if you wanted to buy a copier, $9,500 is the copier, right? And this, as part of this promotion, they've offered to let you pay $10,000 in 1 year rather than to pay today. If the risk-free rate is 7%, is this a good deal or not? Well, what's the net present value? Well, we can calculate the net present value, or, this essentially is what they ask us to do. What is that net present value? What if we were to go to, let's go to a spreadsheet and say, okay, well, look, if we go to this technique spreadsheet, the capital budgeting techniques, you can see down here which spreadsheet I'm on. I'm on capital budgeting techniques. Sorry about that, just went out of my space here. But it's the capital budgeting techniques workshop. We just go up in here. We want to spend, what are we going to spend here? $9,500, right? And in the future, we're going to pay this $10,500. And excuse me, I just not thinking of which direction I want to go in. But let's do this a little bit differently, because I think this will be a little bit more helpful for us. I want to go to the time value spreadsheet, the time value worksheet, if you will. Here's the time value of money. And in this time value of money worksheet, what we're going to do is say, look, we have $10,000 in the future. Oops, one too many zeros. And we could spend $9,500 today. The question is, what is the interest rate on that particular strategy, if you will? So it's 1 year from now. Compounding is 1. I get rid of this data down here. We're not going to need that. If we go over here, we'll find that that interest rate is 5.26%. Right? So 5.26% is the interest rate that we would ultimately be paying or earning on this investment. And what you can see here is that the risk-free rate in our problem is 7%. So you'd earn 5.26%, but the risk-free rate is 7%. So if we go forward with this, we can say, well, what is the value of this? Right? We can go through and change that. let's ask the other question. The interest rate is 7%. So the value is, as you see here, as you also see in your slide there, it's 9,345. So which would you rather do? Would you rather spend $9,345, or would you rather spend the $9,500? And of course, you'd rather spend the $9,345. So actually, the net present value of this is $154.21. So essentially, we're getting a bargain here by paying $10,000 1 year from now. Hopefully, that sort of makes sense, I guess, a little bit, right? What if you wanted to start a web hosting business? You decided to and then you decided to go to school. Now that you're back in school, you want to sell the business within the next year. Somebody offered you $200,000 whenever you're ready. Interest rate's 10%. Well, you have some choices that you can make. What are the choices that you can make? Well, you can sell the business now, take the $200,000. You can scale back the business, maybe run a little bit while you're in school for a year, and then sell the business. You're going to have to spend some money now, of course, but you're going to create some profit. Or you can just hire somebody to manage the business and run that for 1 more year, and then sell the business. Again, different expenses. So when we look to the projects, what happens if you sell it today for $200,000? Well, $200,000 is what you would own. What if you were scaling back? Plan 2. It's going to cost you $30,000 today, but at the end of the year, you're going to get $50,000 and then the $200,000. So that would give you a net of $197,000, which is obviously less than selling it now. So the scale back operations, plan 2, is not a good plan. But what if we hired a manager and let them run it? It's going to cost us a little bit more. We'll make a little bit more money. And in the end, actually, the net present value is $22,000 more than selling now. So what should our choice ultimately be? I think it's kind of straightforward, is that you would rather do plan 3 than to do plan 2. So regardless of our preferences for cash today versus in the future, we should always concentrate on maximizing net present value first. We want to increase the wealth of the company. We can then borrow or lend money to shift cash flows so that we can find the best pattern of cash flows. This is what's referred to as the separation theory. And it's not like these are really done sequentially. They're really done at the same time. We're trying to find the assets that we can buy that create value, and at the same time we're trying to figure out how to maximize the cash flows so that we can ultimately have a preference, have a priority of cash flows that's going to be the best cash flow stream for the company. So let's go on to some new topics. The new topic is something called arbitrage. And arbitrage, quite simply, is just when an asset can be found in 2 different markets and they have a difference in price. So what would that ultimately mean? Well, let's say that you could buy a gallon of milk in your hometown for $3. Or you could go down the road and you could buy a gallon of milk for $4. Which one would you rather do? Well, if you're thinking about just buying milk, then obviously you would just buy milk for $3. But there's actually an investing opportunity here. If you buy the $3 worth of milk and you drive down the road to the other place where people are willing to pay $4 for it, you can make $1 for every gallon of milk you sell there. That's an investment opportunity. And if you kind of think about this as happening in a world where the transactions happen instantly, you wouldn't spend any of your own money, you wouldn't take any risks, and you would make money. That's the definition of arbitrage. So essentially, rewording it is, it's the ability to take advantage of differences in prices instantaneously without taking any risks. in a competitive marketplace, there shouldn't be any arbitrage opportunities, because what arbitrage leads itself to, it lends itself to, is to trading. So again, investment opportunities trade simultaneously. They have to have the same price. Now there are some differences. I mean, if you're talking about, let's say that the distance between the place where we're going to be selling this milk, let's say that the distance is 2,000 miles. Well, how are you going to get the milk from here to there? You're going to have to transport it. So that transportation cost has to be incorporated into the price of selling, or the cost of selling, essentially, so that in the end, maybe the milk over there costs more because transportation costs are incorporated. So again, the advantage of the law of one price allows us not to have to deal with checking prices all over the place. You don't have to check for a price all over through all these different suppliers if the world is working in a competitive marketplace. So we don't need to check for varying prices in different markets.